Hi there. Are you an Elliott Wave hater? It's okay. You can admit it. But I'm also hoping that you're open-minded enough to give me an opportunity to change your opinion. Now, I've been posting videos on this channel for years, and from time to time, I receive some spicy feedback from those that just can't accept that Elliott Wave might work. Look at some of this.
As usual, Elliott Wave says nothing of any substance. Elliott Wave doesn't work. Technical analysis is worse than junk. You realize C waves and squiggles and lines and moving averages, hoop-dee-da-da-day. Nonsense is all BS. Your Elliott Wave counts on SPY look completely wrong. Elliott Wave analysis is stupid. It constantly changes. If you try trading based off Elliott Wave, you will lose your ass.
Most people's idea of trading with Elliott Wave is just all wrong. So I'm going to show you 3 things that will reframe your perception of Elliott Wave. And if I'm right, by the end of this video, you might consider adding Elliott Wave to your trading. But either way, leave a comment and let me know what you think. Are you convinced? Are you still not on board with Elliott Wave? And while you're there, don't forget to hit like and subscribe. Okay, let's get started with the 3 things most people have wrong about Elliott Wave. The first, this is the most important, is you've got to start thinking about Elliott Wave as an indicator, just like any other indicator that you can have on your charts. Elliott Wave has come to be seen as some kind of forecasting tool, and people expect it to be perfect. They want it to predict where the market is going 100% of the time. It's just unrealistic. It's never going to happen. So let's get that out of your mind. Elliott Wave is not a crystal ball. If you're trying to approach it like that, you're doomed to fail, because nothing is right 100% of the time. Here's how I think about it. There's 2 types of Elliotticians: those that take a trader's approach and those that take an analyst's approach. In my view, Elliott Wave traders take a shorter-term view when they have money on the line. We're trying to profit. On the other hand, Elliott Wave analysts are pursuing a more academic exercise. They're trying to forecast market tops and bottoms, weeks and months and even years in advance. Long-term forecasts are nice, but on a day-to-day basis, it doesn't help me trade. These Elliott Wave analysts also obsess over their Elliott Wave counts. They keep the counts on their charts manually and update them each day by hand. I mean, again, this is no help to me on a day-to-day basis trading. I want to click a button like this and get an Elliott Wave count, just the same way I can turn on any other indicator, like a MACD, moving average, RSI, whatever you're into. If you can't make Elliott Wave work that simply, then you're going about it the wrong way. And by the way, you don't have to pay thousands of dollars for this anymore. I use these charts at hub.com. The Elliott Wave is free. You can literally go over there, open an account, and start using this Elliott Wave tool for free. And they even give you the education on how to use it and find trades. So you've got no excuse. I'll leave a link in the description and go check it out. But this brings me to my second point. You need to stop worrying about which is the correct Elliott Wave count. In fact, this is one of the biggest criticisms of Elliott Wave. Different analysts have different counts, and I have to say I do get the frustration on this particular point. People look at various Elliott Wave gurus, and I'll say gurus in quotations, and then try to compare their counts. And of course, they're all different. Yes, even though there are specific rules for Elliott Wave, each of these analysts all have different counts because there's no way that human subjectivity is not going to come into play. Let me give you an example. Take a look at this chart of price action for a market that has been trading for the best part of a year. It doesn't matter which market it is. It could be a stock, future, a crypto, Forex. Doesn't matter. Elliott Wave works the same on all markets. What's important is that we can identify the significant highs and lows on this chart. Let's label each of these different points so that we can identify them. We'll start at the right with A, B, C, and D, and so on until we get to the final one on the right, which is labeled 0. Now, if I ask you to point out which of these points are the correct ones to label a 5-wave Elliott Wave impulse pattern, do you think you could do it? Some of you might choose this pattern. We use A and B for wave 1 and 2, and then E and H for 3 and 4, and then finally the wave 5 up here at point 0. Great job! This is a pattern which observes the rules of Elliott Wave. you've labeled an impulse pattern. But wait a second. Some of you are saying you could use different points. You might pick up on point C and D to be used for wave 1 and 2, and then you're looking at point I and J to be wave 3 and 4, but you're ending up at the same point 0 for wave 5. Okay, that's a fair call. This pattern also observes the rules of Elliott Wave. So yes, you could make an argument that this is the correct pattern. Hang on, some of you may have other ideas. These others may agree that point C and D are wave 1 and 2, but they are arguing that since wave 3 should be the strongest and largest wave 3 should be point M, and point N should be wave 4. Well, at least everyone does agree that the pattern ends at wave 5 up at point 0. All right, so we have 3 different counts, all of which meet the criteria for an impulse pattern, and all of which might reasonably be argued to be an accurate account. So do you see the problem? It's the subjectivity. Different people will have different opinions about how to best label a chart. So which one is correct? Is it the blue one, the green one, the purple one? Well, my answer may surprise you. As far as I'm concerned, it doesn't matter which count is correct. What really matters is that you're counting it in a consistent way, i.e. using a piece of software that's doing the counting for you. Why is that important? Well, it's important because if you're going to trade, you need a system you can test, something that you can run consistently to check the likelihood it will be repeatably profitable. And if you're trying to manually count Elliott waves on every chart, as a human, there's no way subjectivity is going to lead to a consistently objective application of the count. So to summarize, my second point for you, to reframe your view of Elliott Wave, stop worrying about whether the counts are correct and make sure they are consistent. All right, let's move on to my third insight, and it's this. Stop worrying about the Elliott Wave count changing. I hear this all the time from people complaining that the Elliott Wave count changed. Here's an example of what I mean. Even with the software doing the count, it's going to update and change from time to time. The markets are dynamic. They're not static. Let's take a look at this scenario. Here we have an impulse wave 5 move to the downside. Based on Elliott Wave rules, when the wave 5 pattern is complete, we can expect a change in direction to the upside. So we're looking for a bullish opportunity. The market starts moving to the upside, so we're going long here. And by the way, I have specific rules for these trade setups, but they're going to be covered in other videos. Our focus here is how Elliott Wave counts can change. So now we're long the market, and it's moving nicely in our direction. But wait a second. Wave 5 just relabeled to wave 3, and this move has become a wave 4. Now the Elliott Wave count is suggesting that the market may reverse to the downside. Based on that, we'll exit our long position, which was nicely profitable. And with this trade, the Fibonacci retracement looks good, so we'll go ahead and enter a short trade. Next, the market keeps moving down, which is good for our position. But hang on, the Elliott Wave count just relabeled again. Now it's an ABC pattern, which is corrective. That makes sense because the market really has traded sideways for the past few months in a range. And by the way, if the terms impulse and corrective are new to you, I'll leave a link to my guide on 5 Elliott Wave patterns that all traders should know in the description below. Basically, a corrective pattern, one that uses letters instead of numbers, means Elliott Wave is telling us to be careful because the trend is unclear at this moment. However, we're still short and our trade is working out. We may want to move our stops closer depending on how you manage your risk. The market resumes its move down, and look, the count has relabeled again. It's detected a potential impulse pattern developing to the downside. So our short trade still looks good. All right, at this point, the market seems to be reversing back to the upside, towards the wave 4 target. So we've probably been stopped out or should exit here. Either way, it's been a good trade. As trading continues, it looks like we've got another bearish wave 4 trade set up here. So we'll go short again. Our stop will be above the wave 4. Okay, well that short didn't work out. We've been stopped out pretty quickly, but it was a small loss because we had our stop in place. So as the market continues to trade, the Fibonacci retracement value is getting too high. It's well past 62%, suggesting this count could change. So we won't be entering any trades with this pattern. Yep, and there you go. We're back to an ABC corrective pattern, which again makes sense because over the past 6 months, this market's been trading in a sideways range and is still in that range. Markets like this make finding directional trades tough, and the Elliott Wave count is warning us. So let's extend our channel because we need to see these key support and resistance levels. The market is still in corrective mode. Hang on, the Elliott Wave count just relabeled again. It's detected a trending pattern forming to the upside. Let's see if we can get an opportunity at the next wave 4 to enter. You can see it's expected to come back to this level, and it has. Now the market has broken back to the upside, so let's get long with our stop under the wave 4. Okay, well once again, it didn't take long, and we've been stopped out. The trade was a loser, and the Elliott Wave count is relabeled. We're back in corrective phase. This market is well entrenched in this channel, so it's important to watch the support and resistance levels because it's continuing to trade sideways. Okay, the count just relabeled yet again. We've got another trending pattern to the upside. You can see the target here above our resistance level. So depending on how aggressive you are, you might want to get in here, or you may want to wait for a break above the resistance line. And there you are. Not only do we break resistance, the Elliott Wave is relabeled again, and it went from a wave 5 to a 3. Now that's a change I love because it tells me there's more strength to this move. So if I hadn't entered before, I'm confident now. And as you can see, it was a great signal and worked out to be a really profitable trade. So now the question is, how do you feel about the Elliott Wave count changing? With all these different counts, we found 5 trades, and we had 3 out of 5 winners in a largely sideways market. And our profits were way bigger than our losses because the Elliott Wave pattern tells us where we can put our stops. So the fact that accounts change is a good thing. Some traders get so outraged about this. They're thinking about it all wrong. The market is dynamic. It's not static. Let me put this in terms of another example that might make sense to you. Let's go back to our chart. Instead of Elliott Wave, let's say you're trying to use a moving average indicator. Just a simple 1030 moving average cross that traders commonly use. Look at all the times the moving averages gave buy signals and then reversed and gave sell signals. It's exactly the same as the Elliott Wave count changing. You get conflicting signals from the moving averages. But for some reason, people seem to accept that with other indicators like moving averages and get whipsawed and change their opinions, yet they don't apply the same logic to Elliott Wave. They expect it to be perfect, and they're willing to trash it, really because they don't understand it. Oh, and one other thing. Look at what happens when you combine the two, Elliott Wave and moving averages. If you wait until they both agree, now you're probably only going to enter 3 of the trades, and those were all winners. That's what you should be doing with Elliott Wave, using it as part of a system with other confirming indicators, which is exactly how I trade. But that's a subject for another video. What I'm saying is you've got to get it through your head that changing Elliott Wave counts are a good thing. The whole power of Elliott Wave is that it reacts dynamically, like the market. So if the pattern changes and there's a better count, or the original count is no longer playing out the way we anticipated, we want to know that as soon as possible so we can update our trading plan and take action. All right, so there you have it. I hope this video has helped you see Elliott Wave in a new light, maybe even convince you to give it another shot. Let me know in the comments below. Did this change your opinion on Elliott Wave? I'd love to hear your thoughts. And of course, if you haven't already, make sure to hit subscribe to this channel so you don't miss any of our future videos. Thanks for watching. I'll see you in the next video. Take care, everyone.